Welcome to This Week in Intelligent Investing, where we examine timely and timeless investment topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Chris Bloomstrand, Phil Ordway, Elliot Turner, and other thought-leading investors. Brought to you by MOI Global. And now, here is your host, John Mihaljevic.
A warm welcome to everybody to another episode of This Week in Intelligent Investing. Joining me today are Phil Ordway and Elliot Turner. Chris Bloomstrand couldn't be here today. He will rejoin us, I think, in 2 weeks. He's got a little bit of a busy period here, but we have a great discussion. Phil will go first, and then we'll go to Elliot. I look forward to what you guys have prepared for today, and look forward to a nice chat here. So, Phil, I'll go to you first. Take it away.
Sure. Thanks, John. So I thought as a discussion topic for this week, I stole this from a bunch of people I've seen kind of conducting this discussion in real time in public or in semi-public, and it's basically just trying to focus on what sorts of ideas, what sorts of effects from the pandemic will prove to be permanent or semi-permanent, meaning in my working definition of it, that they'll last beyond maybe the next 3 or 4 or 5 years. So what sorts of shifts are really going to stay with us? I do subscribe to the belief that this has been kind of a generational moment, and we'll look back on this 5, 10, 20 years from now as a pre and post moment. Maybe even more so than a lot of things we remember, like the financial crisis or 9/11. So I really do think it's that important. But what I think is maybe more interesting, more nuanced, and certainly more applicable to a lot of investing outcomes is you have to be able to answer the question I just posed, which is, we're seeing massive amounts of disruption and change right now, but which ones of those things are actually going to drive behaviors that stay with us versus which ones are going to fade into the background, hopefully in a year or two as things get back to normal. So I've made a list of things that I think are important and interesting. I've kind of sorted them based on my own responses. So I'll throw a couple of them out, and then I want to hear from each one of you guys what you think and push back and tell me where you think you're wrong. So, and part of what spurred this thought was earlier this week, I saw an article that pointed out that new business formation, at least in the United States, is actually up. It's actually growing at its highest rate in a decade. So that's new entities being formed, applications for employer identification numbers at their highest rate through, I think, the end of July that they've been at any point in the year in at least a decade. Now, that's still not enough to make up for all the failures that we're seeing this year. So you're still having a net impact that's negative to the business community for sure. But my thought there is that that is probably temporary, and that we're not going to see any sustained shift toward entrepreneurship and small business. I think you're still going to have this effect that big companies get bigger. I think all the demographic effects, the technology effects, all the things that have been really driving that are likely to stay in place. And so you're seeing this kind of temporary one-off boost to entrepreneurship and new business formation really kind of being done out of necessity. People that have been laid off, people that have been kind of forced into this. But wonder what you guys think about that.
Yeah, I personally agree. I mean, I think, at the end of the day, when something drastically shakes up the world, people adapt and react to it. And one of the natural consequences of this stay-at-home environment is a lot of people couldn't do what they've done on a normal basis. So you try and experiment with new things. And that's really good insofar as, some people are going to figure out something new that really works and run with it. But I kind of think the effect of starting new things is far more temporal than permanent. And I think, you kind of referenced it, but in this environment, it's tended to reward those with immense scale already. So like the big are getting bigger, and things that are small tend to be hurt. Like, so small Main Street businesses have been disproportionately hurt compared to like large big boxes. If you are Walmart, you get to be open as an essential store because you sell groceries, though you could still sell random tchotchkes, school supplies, and clothing, whereas the average Main Street clothing store had to close in some of these places. So like, there's definitely an asymmetry in how the rules of lockdown have impacted big versus small. So yeah, I'm inclined to believe that this is a temporary shift towards entrepreneurialism, but it's also part of human nature. So anytime we have something really big, really calamitous, that's how people are going to respond.
I agree. And where I was kind of going with it is where you were taking it without maybe even realizing it, is that one of the big pushbacks, and I'm certainly sympathetic to this line of thought, is that you look at some of these world-beating gigantic businesses right now, and you'd expect the law of large numbers to kick in at some point and the growth rate to eventually slow down. It doesn't seem to be reflected in the price this year that you're seeing, but this would be one way that those companies could potentially be slowed down, as if you saw a massive wave of kind of new, smaller companies starting up. And again, it's not clear even what kind of companies are included in this data. It could be lots of little bakeries and restaurants. But my strong belief would be that, with 70 or 80% odds that we'll look back 5 years from now and the big will have gotten bigger and we won't have seen any sustained massive uptick in entrepreneurship. John, do you disagree or?
I mostly agree. I do think a lot of it is just out of necessity, people, not being able to go to work or getting laid off. I do think there's been this underlying trend, albeit from a really low base, of so-called digital nomads, kind of people who figure out a way to be, small entrepreneurs online. And I could see some of that being pulled forward. That's a growth trend for sure. And just like, some of the online adoption being pulled forward, maybe there's a little bit of an effect there. But for the most part, I do think it's temporary.
Yeah, one thing I'd reference anecdotally that I think matters, and I think John kind of tapped into it there. I know a lot of people who are like, I wasn't happy with my life and I wasn't in a place where I could consider changing anything until the world changed. And so therefore today I am making these drastic changes. So there's definitely something to that element of it too, where certain people like have seen opportunities in this digital nomad landscape to kind of attack a certain line of business that before, the whole world changed, wasn't really practical for them to consider.
Yep.
Yeah, interesting. And that's actually a good segue into the next one, which is this notion of either digital nomads or permanently working from home, and parlaying that into the exodus from cities. I tend to believe pretty strongly, again, 70 or 80% confidence, that the working from home trend and the exodus from cities will be faded dramatically 3 to 5 years from now. I think it's absolutely ridiculous when you see the article that got some attention a few weeks ago that New York City is dead forever, or that everybody's basically going to work from a cabin in Wyoming or some nonsense like that. I mean, look, I do think you have massive problems in the short run, right? Particularly in some cities that have overbuilt their commercial real estate markets. New York City certainly has had a severe impact from this virus and will feel pain on multiple levels, including the fiscal fallout there. But, I actually looked up the data, which I thought were really interesting. New York City's population was basically flat for a couple of decades after World War II. Then we all know what happened in the 1970s. The population in New York City fell 10, 11, 12% for a decade there of the 1970s. And it really didn't have any big growth in resurgence in that population until after 9/11, when again, a lot of the popular narrative was that New York City was, kind of past its prime. Likewise, London, inner London, was down almost 50% in population over the century ended in 2000. Between 1901 and 2001, it was still down between 1950 and 2020. So over 70 years, inner London. And then greater London was basically flat since World War II. I think everyone would agree London's done okay, and New York's done okay over that period. So I just find this notion that people will no longer congregate in or flock to big cities. I mean, these cities still contain a massive amount of the economic engine that drives the world. They have all of the cultural institutions, a lot of the great, resources that people need, and people just naturally want to be together. And I think that applies to the work from home phenomenon as well. I think people like being together. I think people need that social interaction. I think there's a business purpose to be served from it too. So I could definitely see a world where there is more remote work. I could see a world where instead of commuting a long distance 5 days a week, you only do it 3 or 4 days a week. But I would drastically distance myself from these pronouncements that, work from home is going to mean the end of commercial real estate, or that we're going to be at 50% occupancy levels forever, or that New York City's dead or anything like that.
Yeah, I'm a little, on the one hand, on the other hand, sort of, because the way I see things, I believe there's going to be a pretty large exodus from New York City. It's underway. I see it where I am in Fairfield County, Connecticut. Like the moving trucks are coming in pretty regularly. The beauty of that is the biggest problem New York City had faced, and a big part of a great story about Brooklyn's renaissance and the outer boroughs rising, but really the driving force there was New York City had gotten so freaking expensive. Right. That the typical young person who made the city so vibrant in the first place couldn't afford to live there anymore. So as these people who have the means are leaving New York City for the suburbs, they're doing so quickly. They're driving down prices. I think it's opening the door for the next generation of young people who will shape the city to come in. So I think it's both. I think both sides are true. On work from home, I get a lot of different answers, but having gone from working from home for a long time to having had an office for a year and a half, and now today is literally the first day that I'm not paying rent again. So it feels like a weird day after all. It's I think going to be pretty nuanced. I think the reality is neither more work from home nor less. It's going to be employers are a little more willing to give their employees some leash to work from home a greater portion of days than before. And I think that's the case because not only have employees proven that without constant oversight, they could still get their work done, but also people are going to be far better equipped for it now, right? Like in the past, you might have had a pretty poor setup for it. And you wouldn't necessarily, as an employer, expect people to be capable of doing everything. But now, that's no longer the case. But I do think people, especially in creative fields, have to go to work. Like you have to see people. You have to butt heads and, refine your ideas. And I think, there's no way around that reality. Perhaps in certain kinds of highly automated or siloed fields, work from home is a little more permanent. But by and large, I don't think it's going to be this sweeping societal change.
All right. Sounds like I haven't generated too much disagreement so far. What about you, John?
So, I think companies in terms of the work from home will just give employees more options. And I do think that'll result in just the utilization of the office space going down. And then over time, companies probably needing a bit less office space. In terms of cities, I also think, for the most part, you're not going to see a big change there longer term. I do think some of the excesses on the edges will be curbed. So San Francisco real estate prices getting out of hand, that's clearly now going the other way. And, those kinds of effects, if you think back to Tokyo real estate in the late 80s, it was just ridiculous. And, the event we had this year is the kind of catalyst that could kind of put an end to a bubble of that sort. And we're probably seeing some of that playing out. But I think longer term, in terms of cities versus rural, there are probably even bigger trends that are driving this than anything COVID related. I mean, I'm thinking of just where the workforce overall is going. And as, technology keeps marching forward, there's going to be just a ton of labor that's undifferentiated and really just commoditized. And that labor is going to have a hard time finding work anywhere other than in cities. So I think this mega trend of cities getting bigger could even continue for quite a while.
Yeah, that's well said. There's a lot of nuance in there, so I didn't really define the question as tightly as I probably should have, but I think all those points are thoughtful and valid. So a couple other ones that probably won't generate much controversy. I think you've seen it certainly reflected in the numbers, both the data, the sales data, the operating data, and the market valuations of e-commerce continuing to take share from physical. I think that would probably get near unanimous agreement, the digitization of everything and that pull on the economy. Likewise, what do you guys think about the effects of this, massive shock to the economy worldwide and individually in unique countries, and what that means for monetary policy and interest rates? So if I were to say, let's say 5 years from now, do you think we've escaped, 1.5% on the 10-year U.S. Treasury? I mean, or put differently, are we kind of stuck in this lower, the very lower reaches of the curve here for the better part of the next decade?
Yeah, I mean, I think one of the challenging situations of it all is we were just nearing some degree of the upper end of where the economy was comfortable with rates going for the aftermath of the great financial crisis. And, even before COVID, we had hit a pause, and the debate was, whether, how far down this cycle of rate cuts would take us after having hit that first peak. And so, we never truly got to kind of complete that experiment before COVID. There are two things I struggle with. One is the companies who are beneficiaries here have the resources to completely reinvent and invest in their capabilities to adapt to the new world and to accommodate new volumes. But some of the old world stuff is going to be left with a whole lot of slack. So on the one hand, you're well greased and things should move along rather smoothly. On the other hand, you're going to have, real oversupply. And so I don't know how those competing forces shake out, but considering we finally will have a better demographic tailwind starting, next year, maybe, I'm inclined to be an optimist and say by 5 years, we get back to whatever the normal was we were approaching before COVID, in the immediate preceding time period.
Interesting. And I'm certainly not capable of putting a precise forecast on the 10-year Treasury, even 5 days out, let alone 5 years out. So that was not really the point. I think that was well said. John, do you think we'll see any big shake up there? Or?
Well, it's probably beyond the scope of this discussion to really examine this issue, because so much goes into 10-year, and even if you look even further out, 30-year interest rates. Right now, there seems to be a consensus that if the economy is weak, those rates go down. We're certainly seeing it in Europe even more than in the US. I mean, the 30-year interest rate in Europe in euros is actually slightly negative right now. It's minus 0.1% on the 30-year, and that just seems ridiculous if you think about the monetary stimulus that's being put in, and whether you would actually tie up your money for 30 years. I mean, this is literally investing 1,000 euros today to in 2050 get less than 1,000 back in nominal euros. I'm not sure anyone sane would actually make that bet. So, but that's kind of the perception, because there's slack, because the economy is weak and so forth. And I think people forget that you have historically tons of examples of very weak economies with runaway inflation. I mean, Venezuela doesn't have a strong economy. You don't need a strong economy to have inflation. And we're just going to have to wait and see what happens with these monetary experiments, with the Fed expanding its balance sheet. That's clearly monetizing the debt. And the verdict's out, but I do think there's a very good chance that this long-term trend that we've had since basically the early 80s of long-term rates coming down, that's going to reverse at some point.
Interesting. Yeah, so that's well said as well. And I think that's where it gets really interesting, is if you think that does ever reverse, even on a medium-term kind of time horizon, there's plenty of opportunity out there, whether it's in financials or otherwise. If you don't, it gets really hard to own some things in that world, right? And likewise, I mean, I think a corollary to the same debate that is almost infinitely complex is what happens to the price of oil and gas. I mean, as you've seen so much demand destruction with such a lockdown of travel this year, at the same time that you have maybe an accelerating trend away from those fossil fuels, but at the same time you've had a massive amount of supply come out of the market. So what happens over the next 3 to 5 years there? I mean, likewise, I just kind of shake my head. I certainly wouldn't want to bet on significantly higher prices, but as the old saying goes, I mean, the cure for low prices is low prices. So maybe that'll prove true again here. I don't know.
Yeah, that's a tough one. I mean, I remember looking at natural gas some years ago, and that was exactly what the CEO of MCF, ticker MCF, was saying. It never came to pass for natural gas. And so that's a really tough one. I've been thinking about it a lot. At what point does oil and gas become like thermal coal, where basically it doesn't really matter how much supply destruction you have because the demand destruction is even greater, and it just becomes an untenable investment area. But sentiment is probably so bad in that space right now that there are opportunities, but are they really long-term opportunities? That's the question.
And there's one more confounding factor, which is that oil has never been a truly efficient market. You have big countries keeping supply off to kind of defend price. So like the incentive to keep supply off to defend price goes away if price is just kind of low with declining demand.
Yeah. And the minute you have a price spike, let's say, it can be really temporary because a lot of this supply that's shut in now or just struggling and would come off could easily, ramp back up.
Mm-hmm.
Yeah. A couple other ones before we move on that I think are interesting and worth thinking about that are a little narrower and maybe easier to define and get our arms around is business travel. So it's kind of the flip side of what we argued a minute ago about working from home. And my thought that, there'll be some reduction there, but we'll get back to 80 or 90% of normal maybe. If normal was 2019, 3 to 5 years from now, we'll get back to 80% of that level in terms of in the office work. I'm not so sure on business travel. I just think if you look at the numbers and look at the high frequency business traveler, the traveler who spends the majority of the week on the road, the number of trips that are comprised of sort of one-off internal functions, sales meetings, one-on-one meetings that can have proven to all be very easily replaced by a 30-minute, 1 hour, even a multi-hour video conference. I just think a lot of that is probably going to prove to be permanent. So it makes it really difficult to start handicapping the odds of things like airlines and hotels and various components of the hospitality and travel sectors, where I think leisure travel will probably come back and be as strong as it ever was. I'm just not sure that some of those extremely frequent road warriors that were always traveling and really make up the vast majority of the profits in that ecosystem, I'm not sure they're going to come back to maybe 60, 70, 80% of where they were on the high end before.
Yeah, I really waver on this one. And my answer kind of depends on the day and what I'm thinking about and who I'm thinking about. And I don't think the answer is like, I think it depends on whether you're speaking about 1 year post kind of return to normal, 3 years on, or 5 years on.
Yeah, I think you're right. I think I was doing 3 to 5 because I think for the next 12 months, even the next 24 months, I think all bets are kind of off. So.
Oh yeah, no, but I mean, even like from the point when you're talking about we get to normal, okay. people don't feel the risk in their life. Because I do think the first year there's going to be a lot of pent up, like we did handshake deals over Zoom, but we want to see each other, sit down face to face and flesh out certain realities or
good point. Yep.
Elements to the relationship. Beyond that, though, I do think there's like big risk for certain kinds of convention-driven sales businesses. I think, just from talking to people in different industries, in B2B space and certain kinds of advertisers, I've really gotten the impression people have gotten like a new, leaner sales muscle going on where they're able to still generate and convert sales at a similar rate before, so long as they're general, consistent with what you'd expect in their business right now, without having to do these kinds of conventions that are really quite expensive and cost a lot. So if you're able to get the same volume of sales with spending a whole lot less, like why would you ramp it up? It's not a bad boost to margin. So I think it's not necessarily going to come from a lack of willingness to travel from employees. I think it's going to come from like a much more bottom line orientation at some of these companies who realize that they don't need that level of travel to convert to their desired level of sales. So I really do think there's going to be some sort of like permanent decline in the number of people who travel. But then again, I also do think that there are, I know plenty of them, road warriors who are very eager to get back out there, very eager.
Yeah, I think I agree with that. I think where there's a high expense sensitivity, it's hard to make the case that you need all the travel that you had before Zoom and so forth. So I do think that's going to impact it. I wonder how much of the business travel had a social component as well. Those conventions, they become kind of social events, and it's almost like rewarding an employee to be able to go to something like that. So, to the extent that there's a social component, I think we will see people traveling again.
No, it's a fair point. There's definitely a social component. I don't think you can ignore that. That's definitely true. And then the last two that are somewhat related are that I would tend to believe that we will see a more or less permanent reordering of the global supply chains that I think a lot of people would argue got stretched too thin, had too many waypoints along the way, touched too many different geographies, and became so hyper efficient from a immediate working capital and margin perspective that they became unreliable and suboptimal in the grand scheme of things, whether that's things like pharmaceutical ingredients or medical equipment, or even just bigger items that require so much energy intensity to ship them around the world, that I think you'll see more or less a permanent reshoring closer to the end markets they spent. Implications are really massive in terms of capital spending and margins in both good ways and bad, and the winners and losers that it's going to create. And likewise, I think you're going to see a kind of a permanent reordering of the world's international relations along these lines. I think you were already seeing, if not a partial reversal in attitude, but at least a somewhat of a slowdown in the globalization trends that you saw over the prior couple of decades. And I think that's likely to at least be a 3 to 5 year kind of semi-permanent outcome from the pandemic. What do you guys think?
Yeah, I think especially in critical areas, you're going to see more redundancies built into the supply system. But on the flip side of that, I think you're also going to see, especially where we're seeing from the COVID beneficiaries, like incredible rates of investment in supply chain logistics and efficiencies. So they're going to get better at the last mile stuff too. So more redundancies on the big stuff, bringing it together from around the world, and more efficiency on the closer to the door kind of stuff. And I think, that investment's really just starting now, because some of it you couldn't even make during lockdowns or stay-at-homes until certain supply shortages ended in their own rights. So I think that's going to have big ramifications for a lot of industries, for a lot of people, for, how some countries will benefit and others won't. So that's definitely one of the areas I've been thinking about a whole lot. Like, it came up when we were talking about Nike last week. It's an area that I'm really, really keen to. And, I think you're really onto something there. Right on.
So I'll be a little bit of a cynic and disagree just a little bit. Because I feel like if there's a profit motive, the people running these companies, they're still going to want to get the last bit of juice out of the supply chains, and they're not going to be the ones deciding that some country is risky politically and could be an adversary down the road and so forth. I feel like that would have to be politically mandated in order to really stick, and that may happen, but I feel like when you have a CEO from HBS whose bonus depends on this year's profit, he's going to run the supply chain as efficiently as he can, and he's not going to be thinking about some potential pandemic 10 years from now or some other event that would require a bigger cushion. I just feel I'm just a little bit more cynical there in terms of human nature when it comes to the profit motive. And, you think about just other examples, like why do people keep lending to Argentina after it's defaulted like 2 or 3 times? Somehow there's a short memory there. And I feel like with this kind of thing, there might be a short memory as well, unless there's really some, geopolitical clashes that'll happen that may kind of force companies to adapt.
Those are great points. And I could well be underestimating the impact of incentives, which are often the most important thing in any sort of calculation like this. And I do think there will be some mandates, either regulatory, legislative, some sort of top-down forcing mechanism that requires some element of this. But you could very well be right. And, maybe as a coda, if I can figure out how to do it easily, I'll put up some sort of long bets or good judgment project style format for this, and we can all put in our confidence, and then 3 to 5 years from now, whatever day we pick, we can go back and calculate everybody's Briar scores and see who got this right. That one would be a tough one because, and a couple of these would be tough because it'd be hard to really calculate them numerically. But I'm with you, John. That's a great point that that human history is so full of examples of people getting kicked in the teeth like this, and then some short time later they forget about it and do it all over again. So we'll see.
Yep.
Well, I had 2 more. If I could add 2 more questions to this to keep it going a little bit, if you guys don't mind, because I find this interesting, and I figured it would be helpful to come with a couple of my own. What do you guys think? A game?
Yeah. No. Yeah.
Yeah.
All right. So number one that I was thinking about, before COVID, it was getting pretty popular to think that with the rise of Uber and ride sharing, that the need for cars was going to decline in the foreseeable future. It was a very popular conversation that, certain people will never need cars again. But I'm wondering what you guys think about the future of car ownership. Well, I guess you got to separate the US and the rest of the world, but for the most part, for the US and the developed world, would you expect the cars per household to stay the same, rise, or decline over the next 5 years? Personally, I think I know a lot of people who are getting cars for the first time, like city people in particular, who had been pretty reliant on how simple it was to travel without having a car. There was no real friction anymore. But now you find yourself not necessarily wanting to be stuck if a lockdown hits, not necessarily fully trusting of the strangers whose company you'd be in very close quarters for ideal transmission. And then, generally, exodus from cities to burbs is pretty supportive of car ownership. So I'm somewhat sanguine on it, but I, definitely find a lot of resistance on that. Curious what you guys think.
I'll take somewhat of a cop-out on this one and say that I don't think the virus will take whatever was going to happen 5 to 10 years from now and change it very much. So I've thought about this a lot. I've always been somewhat skeptical that you were going to be able to have enough autonomous vehicle penetration into the non-big cities. So even out into the suburbs, or particularly out into more rural areas, I didn't see how that was going to work in the next, call it, decade at least. And I still don't think that'll have any impact here. To your point, there's been a huge surge in people buying cars this year for the first time. And I think that makes all the sense in the world. And I think that impact will last at least into the next few years. Does it really persist 3 to 5 years from now? I mean, the benefits of ride sharing were pretty clear. It may have been taken too far, so it may have slowed down that progress for sure. But I tend to think that if those were going to be replaced by roving fleets of autonomous vehicles that you dialed up on demand in or around a city. I think that'll probably still happen on whatever time horizon. And I don't think the virus, in terms of what you said, which is driving the whole conversation right now, which is I don't want to be stuck. I don't want to share a ride with another person. I don't trust what's going on there. All that stuff is going to dominate for the next year or two, probably. Beyond that, I think it'll probably fade.
Yeah, I agree with Phil. I think, in the short term, clearly, I much prefer to drive instead of taking the bus or the train. So miles driven probably going up during the pandemic. Longer term, I think it's going to depend on how well this can be done in terms of autonomous driving. Are those applications going to be so good that you can have a great experience? And so we don't know how long that's going to take. Probably at some point it will happen, especially in more dense areas. But you take, let's say, Uber and taxis. Uber kind of expanded that market. It didn't just take away from existing taxis, but actually grew the market. And I think somebody had a really good article on that, kind of how those kinds of startups can actually just grow the market size in a huge way. And I think that would need to happen with autonomous cars, where basically it's such a good user experience that you would choose that over having your own vehicle. And the hurdle's going to be greater the more one drives, the more one needs a car.
Yeah, that all makes sense. Yeah, it's definitely part of what I waver on, right? Like, people like driving and all, but at the end of the day, if driverless cars do make it that much easier and it's safe and it could be rolled out and scale, I mean, that's definitely going to change habits one way or another.
And to answer your question, I think that's an important part of it is that, car ownership per household. So I think regardless of my skepticism about applications outside of city cores, I do think if you get 5 years out from the pandemic, I do think you'll probably still see a decline in car ownership per household, where you just have so many households right now that require one or two cars per household to be owned. And I think that number will come down from whatever it is today to something lower than that 5 years from now.
Yeah, it's just been interesting seeing this surge in car sales while everyone's not, a good chunk of the commuter base isn't commuting at all, right? So there are other factors that people are considering than day-to-day utility for why they need a car. One of the arguments I'd always contended is, suburban families with kids, your car is another piece of storage, not just transportation. Like, you have everything you need for various activities with you. It's hard to rely on, a random cube coming to pick you up, not knowing which materials you'll need for the next activity, sort of thing.
Yep. I would agree with that. It's certainly much easier to leave your stuff in the car than to always remember what to take with you.
Right. One less thing to think about. So the next question I had, my last one on this topic, is somewhat similar. And I wanted to ask you guys what you think about the trend in spend toward experiential over physical things. And so this was a huge trend heading, basically for the last decade, really, out of the financial crisis into COVID. And, obviously with stay-at-home orders, experiential spend gets curtailed meaningfully, though some of it did shift to stuff like outdoors. So a lot more spend on things to engage with the outdoors. So there's definitely like a place where things are experiential in their own sense, right? You buy a kayak, that's a little different than just buying a thing. But I guess the question is like, what happens with experiential spend from here? I've kind of had this like working hypothesis that, once this is over, we're going to experience something like the Roaring 20s, where there's so much pent up, like party-like emotion, where people want to be incredibly social and want to be out there doing things after having, nothing makes you want to do things more than not being able to do them. That, we could have a pretty long, fueled, fun fest. But I'm curious what other people think. Like, will experiential spend come back, or will people, kind of go back to kind of the more materialistic aughts trends?
What do you think, John? You want to go first this time?
Yeah, I mean, I don't have a great view on this. I guess I personally would say it will come back in terms of experiential. Right now in the pandemic, it's been easy to buy stuff because that gets shipped to your door. You don't have to worry about getting infected. So I've probably ordered too much stuff. And I'm pretty eager to do the experiential stuff again, to go to a soccer game, in Germany with my son, with a full stadium and so forth. So I could definitely see it, but I don't know whether it's going to be a huge trend, because you also got to consider people's ability to spend, what's their disposable income. And I don't think those trends are that positive over the medium to long term. So I don't really know if people will have the means to spend a ton.
Yeah, I think the data are interesting on this in that, as soon as people had to cancel their trips and vacations and a lot of their experiential leisure spending this year, you saw that all pretty much get put into stuff. So they're going to Home Depot and remodeling their homes and buying stuff on Amazon. And I think that coincides with people kind of forcibly, in many cases, being shut out of the relatively small urban apartments into bigger housing units elsewhere. So I think that's certainly true for now. I think I would bet pretty strongly that once you get 2-3 years out, you'll probably, one, see a snapback, like you said, Elliot, and then two, I think you'll get right back on the trend that was in place previously, away from buying flashy, expensive objects and going more towards experiential. So that's certainly an area I've been looking to try to exploit, is how do you take advantage of that, take the near-term pain that's going to almost inevitably be there over the next 6, 12, hopefully not much longer months than that. But I think that's just almost unavoidable. I think the trends that were driving that are still very much in place. And I just don't see us, pretty much any Western society, reversing that experiential preference trend.
Yeah, it seems like it's a generational force. It really does.
I think that's right.
Okay, great. Well, thanks. That was a great discussion, guys. Elliot, why don't you take it away with your actual topic for the week?
Okay, yeah. So I wanted to talk about one of my favorite setups. I think it's somewhat timely. And then I wanted to kind of open it up and hear from you guys if you had one setup that when you see, you tend to like it a lot. The specific setup I want to talk about is a name borrowed from fantasy baseball. It's called the post-hype sleeper. And I've defined 7 things to look for in a post-hype sleeper. So in baseball, what a post-hype sleeper is in fantasy baseball, it's a player who is a prospect with incredible hype, who has a frustrating first year and is forgotten in his second year. And you could effectively buy on the cheap for asymmetric upside. So, I think that's something that tends to happen in the market a lot. So the 7 things that kind of define a post-hype sleeper for me are a company with a big following and a lot of momentum based on what could be in the future. Number 2 is internal metrics of the company's performance continue moving in a positive direction, even when the stock price stalls. So number 3, despite intrinsic value rising, the pace of advance is slower than what investors were looking for, or some kind of headwinds emerge. Number 4 is momentum and stock price evaporates and leads to a sharp, rapid plunge in the share price. 5 is the momentum overshoots to the downside while business performance continues moving forward, though never exactly gets, number 6, never exactly gets to a deep value investment. It too recently burnt growth investors to get growth kind of multiples, and it's not cheap enough to pull in the value guys, so it's got no natural base. And then number 7 is I like looking for when they've leveled off into a range of apathy for an extended period of time. So typically, the kinds of companies that this happens in, I really like to look for busted IPO setups, companies that IPO and then, have a either waited too long to come public or just were priced way too aggressively when they went public, and had set the bar so high that they have a hard time meeting it. Or really, Non-Gap's talked about this quite a bit in his newsletter, but this idea that companies kind of take a couple years to forge their identity and express who they are when they go public, that it's, this natural act of turning over your investor base and really your ethos as a company. A lot of employees had waited for this moment to cash out their stock and move on. So there's just a whole lot of change going on. So change is one of those things I like to invest around. And in these kinds of situations, you end up with, I think pretty good opportunities. I'd say at this point, a decent chunk of my book I'd define as, at least when I commence the position, not necessarily today, but when I commence the position, by and large, I've bought a lot of these post-hype sleepers, and I think it's been a pretty lucrative area for me to look. And with a lot of IPOs going on right now, it's the reason why I'll learn about these IPOs. I don't have any interest per se in buying them because I don't have special relationships that I get these sweetheart prices. Congrats to Mr. Buffett and team for their awesome score on Snowflake, but I don't have the same network and connections. I got to wait for these companies to not work as public equities for some period of time before I could step in. So post-hype sleeper, that's I'd say my single favorite investment setup of them all. Curious if this is something that you guys look at specifically, or really more curious what your favorite setup might be, like a certain kind of thing that when you see in the market you want to jump.
Yeah, I think this is a great topic, and it's almost too bad if anybody doesn't follow baseball, or particularly fantasy baseball. I happen to love both baseball and fantasy baseball. I'm playing a couple of leagues, and it's just awesome. And the parallels to this topic are crystal clear, as you said. And I actually just pulled up a couple of articles that I read kind of religiously every spring. And, they do the exact same thing. They take someone that has to have been ranked on their prior year list of the top 100 prospects. So baseball players that haven't yet reached the majors or have very limited experience in the majors. And they've had one or more failed stints at the major league level. So I think this is similar to your busted IPO type of theory. Like these were guys that got at least some initial call up to the major leagues, but then got sent back down to AAA, which happens all the time. I mean, it happens because of injuries. It happens because of bad GM or managerial decisions. It happens because of playing time considerations and financial contracts and all kinds of stuff. So it's really not a very good indicator. Everybody loves to think of like the superstar prospect that, gets drafted straight out of high school and goes straight to the big leagues and never gets sent down. But the fact is that there aren't that many Mike Trouts out there. There's Hall of Famers that take years and years and years to finally stick in the big leagues. And after that first year, you may get a tiny sample size of 50 at-bats or 100 at-bats where it just doesn't go well and you get sent back down to the big leagues. But that really doesn't change the big picture very much, which I think is exactly your analogy here. So I would add to that a couple of things. Fallen Angels, which was an enormously profitable area of investing to exploit for many years, which is where you get kind of an arbitrary decision out of the rating agencies to downgrade a company, an issuer, or a security, and it creates kind of unnatural selling pressure. Failed phase 2, phase 3 FDA clinical trials for pharmaceuticals, not an area that I exploit personally, but takes a very high level of expertise, but can be done just extraordinarily well. It's just awesome to see. And it's a huge area of inefficiency. Bankruptcies and forced selling are probably my single favorite area. Unfortunately, it's been very barren ground for the last, 7, 8 years, really 10 years. But you see this all the time where an otherwise good business has some unique problem that may or may not pertain to the underlying core commercial enterprise, a bad balance sheet, a legal problem, some sort of one-off crazy exogenous shock. And so they get sent back down to something worse than the minor leagues. They get sent to bankruptcy court, but the underlying prospects are still there. Similar to what you said, busted IPOs maybe, or just, sort of a secular disaster. I mean, if you look at some of the best businesses and the best returning investments you could have made. I mean, post.com bust, the NASDAQ peak of 2000 and then what happened in 2001 and into 2002. And the businesses that had really already proven their merits and the leadership had borne out a lot of success, but the prices just got obliterated. Everybody left them for dead. It's kind of similar to what you were describing. I think that's an enormously profitable field to go hunting in, because you don't have to make huge bets on something speculative and what may happen, what may not happen. It's already kind of been proven out to you. It's just you get a bite at it at a whole new price. So those are some areas that I would highlight. I think it's a fantastic framework and hopefully a concept or a thought that people can ingrain beyond just the narrow, nerdy concept of baseball and fantasy baseball.
Yeah, I agree. And Elliot, I think you talked about the post-hype sleeper at one of our conferences a few years ago. I don't remember which company it was in relation
to. Grubhub last spring.
Okay.
Spring of 2019, to be clear.
Yeah. So that's a great setup. I've looked into it. I don't know if you would put Twitter into that camp, maybe starting to come out of that camp, but
I think so.
Yeah. Just in terms of kind of what I would look at, a few setups, if you will. I mean, Twitter for me is clearly one of those setups where it's under monetized. It has the usage, the engagement, and so forth, but it's under monetized, and people are too focused on the financial numbers, and they're not focused enough on the engagement numbers or the sheer user numbers. So that's a great setup that I think at some point you had that with Facebook. At an earlier point, you had that with Yahoo, where basically these companies were building engagement and they hadn't turned on monetization yet. And paradoxically, the market just does not have a lot of imagination when it comes to that, even though it's not that hard to turn on. I mean, how hard has it been for Twitter to make its ads more relevant? I'm seeing a lot more relevant ads from Twitter in the last couple of months. And they couldn't get it done for a while, but just fundamentally, it's something that's doable. It's not like going to another planet. So I like that setup. Another setup that I like, kind of going beyond technology to maybe an area that's closer to home for you guys, investment management. How often have we heard that the time to back an investment manager that you think has a good strategy, is smart, has the right philosophy, is when that person has had a period of underperformance. And then comes the period of underperformance, and then everybody runs away and says, well, no, but he's really lost it. Well, maybe not. But one name that comes to mind right now is David Einhorn. I think super smart guy. Clearly his style has been out of favor, but here's a guy, and you've got the publicly traded vehicle. He's got a publicly traded vehicle with Greenlight Capital Re, and I'm not recommending it. Do your own research and so forth. But this thing is now trading below $7 a share, and it's got tangible book value of about 11. And there's a good chance that at some point Einhorn's fortunes will turn, and that may come sooner rather than later, because the discrepancy between value and tech valuations has never been higher. And, when that happens, you're not just going to have performance come back for Greenlight, but the discount would likely close as well. And then I'll just mention one last thing that I also kind of like. It has to do pretty much with cyclicals, where there's a commodity type business. One example where you really have a very strong trend to reversion to the mean is refining and refining margins. And those stocks just tend to get completely crushed, but refining capacity isn't going up. And that at some point those margins will reverse, and then the stocks just rebound really, really big. Maybe it's tough to say on the timing front. So that's why you get those kinds of opportunities, but when the turn comes, it's really pretty violent. And there's a lot of examples now in the broader oil and gas sector as well of actually really good businesses totally crushed. And the one vector that would just unleash huge value is just if the oil price rebounds. And so these companies got crushed through no fault of their own, so to speak. They're being well run. They're allocating capital in a smart way. Some of them, obviously. And then you just get this one variable to reverse, which, in all of history, it's always happened. Now, you could say this time is different, and it might be because of just the trends we have in renewable energy and so forth. So that makes it tougher. But when you have a good company where there's just a commodity price as one vector, and that commodity price has reliably oscillated, at some point it'll oscillate to the upside, and those tend to be good opportunities as well, in my experience.
Yeah,
what do you
those
guys
are all
think?
really good ones.
What do you guys have as ways to avoid mistakes in the area, or how do you evaluate whether it's a post-hype sleeper or whether it's just a busted initial thesis, which is one, I guess if I had to pick my favorite again, it would be something where you had a bankruptcy that was forced on the company through no fault of its core commercial proposition. So, a broken capital structure, a funding crisis, some sort of legal problem that doesn't, reflect poorly on the business itself. Because there, in a lot of cases, you can buy from forced sellers. You have an ability to have some downside protection wherein you're getting cash or reliably monetizable value that covers, if not all, at least a big chunk of your purchase price. And then you're getting a lot of the upside and potentially, the reorganized entity and the equity there for very little or next to nothing. I mean, it's obvious, right? I mean, it makes total sense that would be an attractive setup. It's easier said than done to find those. But if you're just looking at other situations where, maybe it's an equity or maybe it's something like that, where it's just a company that's stumbled, how do you avoid throwing good money after bad when the market's saying this isn't working anymore?
So yeah, I got a two-part answer to that. But first, got to make a baseball correction. Mike Trout actually was sent down before he became a superstar.
Sorry. You're probably right about that. I shouldn't have
He was
called him
sent down
out,
for a 39-year-old Jason Isringhausen to make room for one more bullpen arm. But it's just like, it's kind of easy.
In his rookie year, he was sent to, I was gonna say A-Rod, because I'm pretty sure when A-Rod when he broke into the major leagues, I don't think he was ever sent down, right? But then I said,
he came up and mashed.
And people won't know who he is. And Mike Trout's probably the best baseball player of his generation. But anyway, good clarification.
Goes to show how after like 8 years, a certain narrative just kind of takes hold. And I thought that at first too. And then I was like, wait, I actually blew this because I had him on my fantasy team and dropped him when he got sent back down because he wasn't ready yet. And that one still burns to this day. So, these kinds of things do happen. So on, how to avoid getting burnt in the post-hype sleeper, I think for me, one of the keys is step one, I've built in, I think, a degree of protection in what I'm identifying as a post-hype sleeper. So I think that step about rising intrinsic value despite a declining stock price is very important to establishing a margin of safety. I don't want to get involved in a company who's actually, hit real problems. I want the problems to be predominantly in the land of sentiment. And now the problem that comes from that is sentiment can become its own vicious cycle, especially in these younger companies where like talent retention is key and stock price is key for that and the narrative. And so once the stock price reverses, you get some sort of brain drain. But I want to make sure that when I'm stepping into a post-hype sleeper, that there is and has been consistently rising intrinsic value. So, maybe I'll be wrong on what my IRR could look like over 5 years, but I want to make sure that in 5 years, I have a high degree of confidence that the company is worth more than it is today. And then I guess the second element that I look for is like constant reevaluation of the thesis and making sure that there's one key variable I can isolate on that is like the biggest sign at the intersection of the qualitative and quantitative that the business is working still, and pay attention and make sure that there's no like real change in the inertia of that one key variable. So that's designed to monitor the intrinsic value rising, but it's something that I think that's the process as things move to stay attuned to whether you're right or wrong. That's how I think about it. How about you? I mean, does that make sense? What would your framework be looking at these kinds of companies?
Should I jump in?
Yeah, please. Yeah.
Absolutely.
Yeah, I don't think I can add much more than Elliot. I mean, you're the kind of the guy on this setup. I would say, yeah, you got to look to metrics other than the stock price, and those metrics have to be going in an opposite direction. Just a couple of examples I'm thinking of now that to me seem like they actually may not be post-hype sleepers, in the sense that they may not recover in terms of their value. Yelp or TripAdvisor, those companies, they had the hype, now they don't. But I also feel like their intrinsic numbers aren't really going in the right direction. Yelp just feels like it's becoming less relevant. I used it at some point, but it just feels like they're not really going to be relevant in the future. Now, I may be missing some niche, use cases for it. So I think, Elliot, you said it the best. I'm just trying to throw out a couple of examples, and if you disagree, I'd love to hear whether...
Those are perfect ones, like right on.
Yeah, the only thing I would say too is because I think my setup was biased towards things where you could buy it cheap from a forced seller. Looking more fundamentally at the business is certainly the key for me. I would try to make sure there's a balance sheet there to absorb some of the shock. So if the stock price is cratered, try to keep that out of your mind and just realize that there's a balance sheet here to support this business. And like you said, has the business itself made any progress? Has the business itself grown? Has it shown that it's producing more value or more customers interacting with it? What do the people that have interacted with the company in the past have to say about it? Just take a owner's mentality about it and ignore the business. It's not going to be perfect, but if you can at least avoid the post-hype sleepers that have really poor, short-term unit economics and are burning a lot of cash and don't have the balance sheet to support themselves, I think that just you get a lot of problems out of the way right there.
Yeah, and you got me thinking. I should add one more element, which gets at the company, how the company that I presented here resolved, because it wasn't great at first, and then was an okay outcome in the end. But one thing I look for in these kinds of in this setup is a company whose existence is strategically significant to someone. So that's potentially there with the two bad examples in TripAdvisor and Yelp. So if it goes wrong, that could have been some degree of defense on the way. Grub ended up, being first Uber was going to buy them, and then Takeaway came over the top. So there was some strategic significance that worked for someone. And you can't always identify that there will be a sale at the end of the day, but you could identify that there will be interested purchasers if things don't work out as you hoped. So that's one more thing I looked at, and it's kind of like consistent with Phil, how you look so intently to the balance sheet for that. It's kind of its own form of more tangible value in that sense.
Can I just throw out some things, since Phil, you talked about the capital structure and the balance sheet, and you're the expert in this, but I've looked at a couple of situations recently that seem intriguing, and I'd love to get your kind of initial hunch. So there's this offshore driller, they're the leader, called Transocean, biggest backlog in the industry, really good assets for that industry. And in rough numbers, about 20 billion tangible book value, 10 billion of that is 20 billion in tangible assets, 10 billion is equity, 10 billion is debt. And the debt now trades at about 20 cents on the dollar. So, if the equity is going to be worthless and you're getting basically the company for 2 billion of 20 billion in assets, and it's the best company in the industry, that kind of seems a bit interesting to me.
Yeah, I haven't looked at it. I mean, I used to know a little bit about the industry years and years ago, fully a decade ago now, I guess, almost. I guess what I would say is, yeah, I don't understand situations like this where anyone would necessarily want to make a big bet on the equity, because it's clearly being implied by people who have done some work and have real money at stake that the equity is worthless. And so, again, you don't want to take the market price action as the end all be all response by any stretch of the imagination is, but it also implies just a kind of a level of greediness that's somewhat unrealistic, because if the debt's trading at 20 cents and it proves not to be the fulcrum and the equity recovers something, you still will have gone from 20 to 100 or something better than 100 on your debt. So you still would have made multiples of your original capital, and you ought to be pretty pleased with that. I mean, you can always buy bolts. You can look at all the trade claims. You can see where all that kind of stuff is trading. But clearly the base rate of companies that have debt trading at 20 cents on the dollar generating any recovery for the equity holders would be infinitesimally small, like, very, very, very rarely ever happens. So, but, look, there are also other things to consider too. I mean, the 20 cents level implies lots of potentially hidden liabilities, at least from the surface. I mean, I do remember from being involved with some oil and gas properties, less on the rig side a little bit, but there are just massive costs to these properties and the physical plant and keeping them up. So, make sure that you really look at it and decide, is this, an asset where, once the bankruptcy case is resolved, potentially could these assets be redeployed quickly, or are they going to take many, many millions of dollars in real cash spending to then ever start generating any sort of economic return again, because that's often the case in these bankruptcies. So,
yeah, thanks. I was definitely thinking about this in terms of buying the debt and assuming that the equity gets wiped out.
There was another case, though. I mean, a friend of mine the other day brought up a retailer here in the U.S. that is filed, and I hadn't been paying attention to it. It was a pretty small company. Tuesday morning, and again, I'm by no means recommending anything here, so please do your own work. But the interesting part that got his attention was that the judge had granted an equity committee. That's something we talked about before. The equity had been, struggling for years. The company had been struggling for years, and the pandemic came along and kind of finished it off. But it actually filed with no financial debt on the balance sheet. So lots of leases and they're trying to reject some of those leases in bankruptcy. But, if you squint really hard, you could see some potential equity recovery there. I think it's still pretty unlikely in a lot of cases, but the granting of the equity committee is what got his attention. What I had to explain was that, that could well be because management's done something wrong and management has violated its duties as it entered or was clearly in the zone of insolvency. So a lot of times the judge will grant that equity committee as a way to kind of slap management on the wrist. It's not meant to necessarily imply that the equity holders in the case have any sort of claim or any hope of retaining any value there. But, it's an interesting one. I mean, the stock there went from 20 cents or something shortly after it filed to 80 or 90 cents now. I mean, it's clearly gone up. You saw all kinds of crazy stuff happen earlier this year with Chesapeake and Hertz, where the common stocks of those companies both traded up dramatically after they filed bankruptcy. In one case, Hertz tried to sell equity to the public after it had filed and declared that its shares were very certainly going to be worthless and they were going to sell you more shares anyway. I mean, it's just bizarre stuff. So you just can't ignore economic reality when you get into these situations.
What's interesting to me also is that when you look at these quote unquote distressed equities that are trading at, huge discounts to book value or at a fraction of book value, some of them will have their bonds at like 20 cents, like the cases with Transocean, but some will have bonds that are trading at par, basically. And
that can be a good sign. I mean, I would say as a rule of thumb with a base rate in the 70, 80, 90% range. So by no means is it foolproof, but it's a good initial stake in the ground to start doing some work, is that if you see the credit price lead the way down. So if the bonds start getting weak or they trade at a very distressed level, like you said, That's generally because some people that have limited upside and lots of risk have decided that there's a big problem here. And in cases of financial distress, it's very often true that the credit is either the first to smell trouble or the sharpest investor in the room. And so the most informed and generally doing the best work. If it's the other way around, which you see, sometimes it's more rare, but where you see, the equity absolutely get destroyed and the bonds are trading at par, and you can kind of work into what that means in terms of interest coverage and overall financial health for the business, that can be a very attractive way. I mean, I would certainly feel way more comfortable making a bet on a quote unquote distressed equity or a levered equity where, the credit markets had sort of deemed the balance sheet to be somewhat healthy and it had bonds trading, in the 90s as opposed to, some absolute shoot for the stars kind of situation where the distressed equity, yeah, sure, could there potentially be value there? But you're talking about, 1 in 50 or 1 in 100, 1 in a million kind of odds to actually ever get there when the bonds are, already beaten up for good reason.
Yeah, I'll just mention one name, and this is by no means a recommendation, but just in case people want to do some research. This Brazilian aircraft maker, Embraer, it's viewed as a fairly high quality company in Brazil and so forth. Got absolutely crushed on the equity side this year, but the bonds or the debt is trading pretty much at par.
Yeah, and I wonder in that case, I've done no work on the company, so take this for what you're paying for it. I wonder there if it's the case, as you often see with some of these companies, it can be economically rational to say, right, that the company should be allowed to basically file for bankruptcy and restructure and have the equity wiped out, but you can't allow the pain to go further up the capital structure than that because you'd basically crush the entire supply chain. Because if you allow the debt and the vendors to take big giant haircuts, it almost becomes an issue of national consequence. I mean, you could certainly have made that case for Boeing here in the U.S. when I read a lot of, press coverage around the 737 MAX. And then when the pandemic hit, you had a lot of people saying that a Boeing bankruptcy was sort of inevitable and you're going to have this haircut and that haircut. And it's like, guys, if we've bailed out the banks and the automakers and stuff, we're definitely going to bail out Boeing. That's just a, political reality in this country. And that Embraer is probably in roughly the same ballpark in Brazil. So that may be a reflection of the fact that people are just equating the credit risk there with almost a sovereign level of risk.
Elliot, after those tangents, anything else that you had on your mind?
Yeah, no, this stuff's interesting for me to hear about. I mean, I wonder, about some of these situations. I watch from afar to see if I'll ever, pounce on anything. Was thinking when you were talking about Transocean a little bit about how the Lowe's family, the Tisch family with Lowe's basically just, let Diamond go bankrupt. It seems a little bit of an ominous sign, but I was thinking similarly to Phil on Embraer being a bit of a national point of pride. So you don't want the bonds to look too bad, or there's incentive for the country to make sure it doesn't get too bad there. One of the situations I found myself scouring just this morning was I'd say probably a pretty similar setup with Rolls-Royce, where it's now, predominantly their enterprise value is their debt, not much market cap left there. And they're going to be doing this rights offering, or so it seems. That was I kind of stopped off the trail to prepare a couple other things. But, that's a situation that seems somewhat similar. They're a national champion of sort. I remember a couple of years back, it was hypothesized that someone might be interested to acquire them, but the British government wouldn't because there's strategic reasons not to. Those have interesting consequences for people kind of sniffing around the equity and the debt in those kinds of situations. So it's not exactly the kind of stuff in my wheelhouse setup I was talking about here, but I do, as a generalist, hop around and look at a little bit of everything. So these are some of the things that have come up for me. So I'd add a couple of those thoughts. I don't know, is Rolls-Royce something either of you guys have looked at this point?
I've looked at it, but it's been years. I mean, some really smart people have been involved there on the investor roles for a while, and I found it, on the one hand, very attractive. On the other hand, very difficult. The accounting was a mess. The sort of corporate leadership and culture and overall performance of the company was hard for me to really wrap my head around and get excited about. And then now the pandemic's hit. I mean, they're still trying to figure out the Trent 1000. The wide body versus narrow body market debate is raging. The long, I don't know what you'd call the next 5 to 10 years in terms of time horizon, but that's going to be tough in terms of the backlog. But you have a long tail of maintenance, and it's certainly a national asset. So I'm with you on that. And likewise, to my point on Embraer, I don't mean to be too cynical, and there could be a very intelligent case to be made that says that because they're going to get some level of national support, you're not going to ever get to the Machiavellian situation of allowing the equity holders to get crushed, but the credit holders to emerge unscathed. And so if you can just pinpoint the right level where you can bear some mark-to-market pain on the equity, that you've got some level of underlying liquidity support coming from this day. I think that's a difficult game to play. And I don't think it's really that bad, frankly, at Rolls-Royce. I haven't really looked at the balance sheet in any detail lately, but it could be interesting from that level too.
Yeah, thanks, Elliot. I hadn't looked at it either, but I do recall folks mentioning Rolls-Royce in the past, making a pretty good case, I thought, at a much higher price. So, yeah, thanks. I may have to go there to get some pain.
Time for a little dumpster diving, right?
Right. Yeah.
Speaking of pain, I have to point this out too, because I find it so interesting. I looked up Mike Trout's history here real quickly. So you're right. He did get sent down. He got drafted in 2010. He made his major league debut in 2011. He got sent down after a whopping 12 games and was sent all the way back to Double-A. But then he came back up later that year. And so this is 2011. But then what's even more interesting is that you could have drafted him in fantasy baseball the next year in 2012. But even in 2012, he started the year at Triple-A. So he did not break spring training with the major league roster in 2012, but he got called up April 28th of that year and then went on to win Rookie of the Year and post maybe the greatest fantasy baseball season in recent memory. And for as good as he's been, that rookie year in which he missed the entire month of April was his highest earning fantasy baseball year ever. So he's never had a statistically better year than the season in which he was the ultimate post-hype sleeper because he missed the entire month of April languishing in Salt Lake City at AAA. So it's just fascinating. I mean, he's the poster child of that. That's good. That's hilarious.
Yeah, I mean, it's a great setup in fantasy baseball and in the stock market. I mean, Javi Baez was similarly, he was atrocious his first 2 stints in the big leagues. He couldn't even touch a fastball. And then, even when he finally made the roster every day, the only reason he did was he played like 7 different positions. So, he was kind of everyone's backup, giving him enough playing time to appear like a regular. And then suddenly he blasted off from there. And I think, Trout, obviously, I don't know if there's as much to the story, but with someone like Javi Baez, there's something to be said about having a lot of resilience and a lot of different ways that you could get yourself chances to be right. Like when you're looking at a stock in the post-hype sleeper setup, like the more different ways that it could go right, the better off you are. And so for Baez, it was key just having a glove where he could kind of play any position on the field. Having a little speed where, no matter what, late in a game, he had an opportunity as like kind of a speedy replacement on the base paths. So just giving people excuses to give you one more chance. I mean, that goes a long way. It's part of what I felt about Twitter when it was like deep in the turnaround doldrums. It was not so much, it was a little bit of a turnaround for sure. But like, for the most part, they had this core audience that wasn't going anywhere, which gives you a lot more chances to kind of experiment and get other things both right and wrong along the path. And, obviously with Trout, yeah, go ahead. Sorry.
I didn't mean to cut you off. I was just going to say, if Mike Trout's the single best example of it in baseball as a post-type sleeper, it was Rookie of the Year, first ballot Hall of Famer, potentially the best of his generation and potentially one of the best fantasy seasons ever in a season when he didn't even get to play in the month of April, basically. I was just looking at Amazon stock, which, IPO'd in 97, went to $100, and then the .com bust hit. And we're approaching the 19th anniversary, which I believe would be next month, sometime here in the month of October. You could have bought it for about $5.51 a share. Looks like the lowest intraday split adjusted, but certainly in the single digits, you had an opportunity there for a few weeks or a few months. But even beyond that, you had a chance to buy it in the teens, as opposed to a price now well over $3,000 for one of the best businesses that's ever existed. So if Mike Trout in 2012 was the best ever post-hype sleeper, maybe Amazon in 2001 was the best ever stock of its kind in that regard.
That's pretty amazing. That's phenomenal. I mean, I think it gets to the point, like a lot of people think this is all too easy to buy good companies and just, kind of tuck them away. It reminds me of Scott Krisaloff at Avondale Asset Management put this post up. I think it was in 2013. The 15 best stocks of the last decade and what extent of drawdown you would have had to realize at max to hold on to them. And of the 15 best stocks, the biggest drawdown was 92% on the way to 1,000% returns for, it looks like it was Wynn. The smallest drawdown was Sherwin-Williams at 42%, and the average drawdown was over 50%. So to hold anything really great, you had to be able to take some lumps along the way. So, I mean, part of the post-hype sleeper idea is you'd rather look at them when they're in the lumps and not have to deal with the worst of the drawdowns. But even for Mike Trout to be demoted for an end of career Jason Isringhausen had to have been a pretty terrible feeling.
And just to stretch this analogy one more time, I hope we're not losing all of our non-sports listeners or any non-baseball fans that are out there, but I'll never forget. And this does actually apply. So Bill James, most people are probably familiar with. He's sort of the father of advanced metrics in baseball and has gone on to really revolutionize the sport. And it's bled over into, European football and all sorts of different sports. And he's been a paid advisor to the Boston Red Sox. It's very influential. There's also a guy in fantasy baseball. There's a couple guys actually. Larry Schechter's written a great book on the subject, and Ron Chandler was kind of one of the original godfathers of really applying quantitative thought and good rigorous analytics to fantasy baseball. And I think anybody that's interested in investing that would read one of their books or read some of the work they've done would be floored at how much overlap there is between these areas of thoughts in terms of looking at businesses and investing in fantasy baseball. But anyway, I'll never forget that after Mike Trout's 2012 season, when he absolutely blew everybody away and posted this unbelievable season, Ron Chandler the next spring before the 2013 season wrote this essay about how he thought Mike Trout was an unbelievable player. He thought he had the brightest possible future in front of him. And then he thought that almost certainly we'd seen the best ever statistical season that Mike Trout would ever put out. And he got ripped. Ron Chandler was called an idiot. They said, you're missing the point. Mike Trout's 21 years old or whatever he was, 20 years old at the time. They're like, this guy is just getting started. He's definitely going to have better seasons. And his price in auction leagues in particular got bid to such insane levels that he hasn't returned a profit in a lot of fantasy baseball leagues that are auction denominated ever since. But Ron Chandler was exactly right. So if you look at what he posted in value in 2012, he's never exceeded that level ever again. He's come close. He came close in 2013. He came really close in 2016. He came close again in 2018. But Ron Chandler was exactly right that the best possible statistical year Mike Trout was ever going to produce happened that first year in his rookie year. And that's carried with him. And so the prices people are paying based on that first rookie year probably inflated his price tag in the market for the next 5 or, maybe even longer year. I mean, it just has stuck with him ever since. But I just thought it was fascinating that Ron Chandler got absolutely torched for that, but he was 100% correct.
It's interesting. I didn't realize that he peaked in WAR per game in that year by.
Well, this wasn't WAR. This was in fantasy value. I'd have to look on WAR. Let me see.
I'm looking at WAR. He beat it by a hair in 2013, but he played decently fewer games. But one of the interesting things that as I'm looking at this becomes clear, like his most of his stats he outdid in other years, but the big variable that made him that much more valuable in 2012 than the other years is he had way more stolen bases than any other year.
Exactly. And that was Ron Chandler's point in this essay was like, guys, you're just not going to see 49 stolen bases very often. And he's exactly right. I mean, he's never posted more than 33, which was the next year. So that was the core of his logic was that, in fantasy baseball, just because of the arbitrary nature of the game, it's that steals matter and they matter a lot. And he was saying, Mike Trout could go on to be an absolutely awesome player, but he's ultimately unlikely to steal so many bases again. He was 100% correct, and his value has reflected that. And Ron Chandler's prediction was absolutely correct, but probably very few people remember that. They just remember him as the guy who, didn't like Mike Trout or whatever, all these crazy narratives that.
It's a tough tag to have stuck on you for so many years.
Exactly. Especially when you were correct, right? I mean, it's bizarre.
People don't like nuance.
Yeah, no, exactly.
I'm still here, guys, although I missed a lot of the discussion, I have to say.
Yeah, sorry, it's a little baseball centric.
Yeah, I'll throw Billy Bean out there just to brandish my credentials.
I mean, look, he would have never existed if it weren't for Bill James. So we're all kind of talking the same language.
I should talk about the book MVP Machine one time for my little section, because I think it's just awesome. And I have more than once tweeted out one excerpt as the explanation for why growth has outperformed value. But it was somewhat facetious, but I think it explains it so damn well. And how the league moved from Billy Bean, who was trying to buy assets for less than they were worth, to kind of obviously we have a bit of history to kind of revise how we think about this, but to the Astros model, where it's really a growth mindset about their players, identifying traits where they could kind of accelerate the value creation in specific vectors. A very different approach toward value in players and building value, like a portfolio of value as a team. So I feel like that would be an interesting one. I'm glad to hear that I got another baseball junkie out here. Always hard to know how far I should push down that path, but I love baseball.
That was the same guy that wrote Big Data Baseball, right? Which is another,
about the Pirates. That was a great book.
Exactly. Yeah. If you're into, nerdy stuff, that's definitely a good one.
Yeah, I find I kind of get better ideas about the market. Reading another investment book, they're kind of all fairly similar. But when you read about it in baseball, it's kind of very similar, with how it's very open-ended too. So it's not just very narrow. Range of outcomes is pretty wide. And, you really could think of both individual securities, so players, or portfolios, how to build a team. So all elements are there. And
just to kind of round out this discussion for folks that want to look up some stocks, you're in European football, there's a bunch of really smart clubs that apply analytics and so forth. And actually, I think the guys that own the Red Sox now own Liverpool Football Club in the UK. But a couple others that are publicly traded that I think do this really well in terms of building value internally with players, or acquiring them really cheap and then selling them for much for multiples. One is Borussia Dortmund out of Germany, ticker BVB. Another is a club in France. The name escapes me right now, but they do a really good job. They made it all the way to the Champions League semifinal this year.
Oh, PSG?
No, it's Lyon.
Oh, Lyon this year?
Yeah. Did really well, even though their budget is much smaller than most other clubs. So there's definitely some things to look at in the public markets for those who are interested.
And I know, all the Malone junkies got to point out, the Atlanta Braves are a publicly traded company, and they have built a really nice crop of young talent. I think taking pretty value-oriented approach to team construction.
We could do a whole segment on just sports economics for sure.
Yeah, definitely.
It's on.
All right, guys. Well, thank you so much. Great discussion. And thanks to everybody for listening as well. Looking forward to talking to you guys next week. Take care.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.